Tell us about the new management structure for NYSE's options exchanges.
We've had a bifurcated management structure at NYSE Options for the last couple of years. And under the new structure, I'll be heading up both the NYSE Arca options and NYSE Amex options platforms. And really, we hope that that's going to provide a nice opportunity for our customers to interact with us in a more efficient way. So we'll continue to have a single trade desk, a single technology platform for both Arca and Amex. Unlike some of the other exchange groups that have multiple exchanges, our technology's been consistent across both from an API, from a fixed messaging standpoint, with really just very minor variations related to market structure for years.
What's your strategy moving forward?
The new approach and the new team structure is really effective right away. But we've got a lot of great people at the NYSE Options team who will really be continuing in their existing capacities. And so from the standpoint of our clients, they'll really be able to continue those relationships and continue interacting with the people at NYSE that they've known and have known well for a number of years. But those individuals will now be able to speak directly in cases where they may not have in the past to both of our market centers.
What's next for NYSE Arca and Amex?
We actually were just approved something we're very pleased with at NYSE Amex options to eliminate position limits on SPY, making that the first physically settled class of options that won't have a position limit. So NYSE Arca options will be issuing a similar rule very shortly, and we certainly would like to see that copied by the other exchanges to attempt to continue to grow that ETF options business across the board. Also, imminently, we'll be releasing our improved risk protection mechanisms on both Amex and Arca. We've had a pretty sophisticated set of risk checks for certain participants, but we'll be expanding them, offering not just transaction, but also contract volume based, as well as what we're calling a percentage of liquidity based risk mitigation mechanism for market makers, and also rolling that out for order sending for order sending firms and for firms that provide liquidity with orders.
Can you give an example of how that would work?
Today, market makers have the ability to indicate the maximum number of trades that they want to make per second before their quotes are kicked out of the exchange. That's nice, but it's not particularly granular in the current environment. So we're reducing the resolution of that measurement period from a second to 100 milliseconds, meaning a market maker who might be perfectly comfortable making 10 trades in a second, but might not be comfortable making 10 trades in 100 milliseconds, that maybe is a little bit too quick, will be able to actually increase their tolerance in terms of the number of trades they make in that period, thereby having fewer false positives where they get kicked out of the market for making a lot of trades in a 1 second period, which might be fine with them. We're also going to be adding a mechanism which will measure risk at the contract level rather than at the trade level. So rather than counting 5 one lots as 5 transactions, a market maker would have the option to say, I've traded 100 contracts, that's too many, irrespective of how many transactions, whether that was one transaction or a larger number. Finally, what we're calling the percentage of liquidity-based risk metric looks at the amount of size that a participant is offering in the market and scales according to that. So somebody who's quoting 10 up on everything might only be willing to trade 50 contracts. Somebody who's quoting 100 up might be willing to trade 500 contracts at that time. And so we'll take into account the size that's being provided in the market when determining at which point that participant might want to have their quotes removed.
Tell us about your risk management tools.
I think our view really is that it's important that it not be a competitive issue. We don't want to create an environment where one exchange perhaps introduces appropriately conservative risk checks and other exchanges choose not to do so in order that perhaps their market makers can shave a couple of microseconds off of acknowledgement times. That works great and makes perhaps that second venue look pretty attractive until one day something goes wrong and it doesn't. So I think an approach that's coordinated across the industry and across exchanges is really ultimately going to be the best solution, and that's the direction that we'd like to see the industry move.
Option volumes are down across the industry. How are you adjusting to a lower volume environment?
Our goal really as an industry is to continue educational outreach, to continue to inform those pension funds, money managers, hedge funds, other large participants that may not be participating in options to the degree that they could, that increased participation in the options market is a smart thing to do. The options product continues to be strong, and in Q2, NYSE and Arca and Amex options combined We're the largest equity options exchange group, and so we certainly look to continue that position in the industry.